Hello and welcome, and thanks for joining us. Today we have a very special guest. We have Ethan Elser joining us from PACE Equity, and we're going to dive deep into what CPACE is and the advantages for developers and property owners that are unaware of the program benefits.
Welcome to the Investor Financing Podcast, where we interview real estate investors and lenders so you can learn all the secrets to getting your projects funded and scale your portfolio. And now, your host, Bo Eckstein.
Ethan Elser. Welcome, and thanks for joining us. Today we have a very special guest. We have Ethan Elser joining us from PACE Equity, and we're going to dive deep into what CPACE is and the advantages for developers and property owners that are unaware of the program benefits. Ethan is responsible for managing and growing the company, including corporate sales and development, market leader development and coaching, project governance with emphasis on quality assurance and support, oversight of the company's processes, systems, tools, management, and marketing. Ethan, thanks for joining us. Today's going to be a great conversation about PACE Equity and the benefits of the program itself. First, I want to just dive in for the viewers and talk generally. What is PACE financing? How does it work?
Sure. Well, thanks for having me today. So PACE financing is a new and innovative tool for commercial real estate capital. It's a state-legislated public-private partnership. PACE stands for Property Assessed Clean Energy. And broadly, what that means is that states are putting legislation in individually that allows access to a new form of capital for construction projects. Construction meaning renovation, CapEx, redevelopment, and ground up new construction. The capital is specifically geared for items in the capital stack which have a quantifiable impact on utility, water spend, renewable energy, and in some states, seismic improvements, resiliency, things like that. The capital is paid back through a long-term special tax assessment on the property. So in a sense, the idea is that the government, the public, so to speak, they're trying to incentivize people to build or renovate in a more energy efficient, sustainable method, create jobs, grow the economy, but they don't want to put taxpayer dollars on the line. So what they do is allow a private company like PACE Equity the power to put a special assessment for a specific project on a property. And that allows us to effectively lend capital that's long-term, fixed rate, and non-recourse at a very, very effective cost of capital to the client.
That was a great explanation. Now, can we dive in from a developer standpoint? Why would a developer want PACE Equity in the capital stack? Can you kind of go over the advantages of PACE Equity in the capital stack, what that means to a developer?
Yeah, absolutely. So the idea is that as you're putting your capital stack together, right now, we're seeing trends that would say that, there's really two options, right? You can get a construction loan from a bank lender or a credit union, and it's going to be, a fairly low cost, but also right now, a fairly low loan to cost, given COVID pressures and, concerns about the economy and all the development that we've had, leading up to it. Or you can probably get a high cost, higher leverage construction loan from, say, a debt fund or, kind of non-bank institution. So what PACE Equity does is we work in both of those scenarios to either do one of two things. One, in a low leverage construction loan, we can provide 10 to 25% of the capital stack typically. I can talk about how, that sizing works later on. At a much lower cost than, say, the outside equity that you're going to have to raise to get that project done is going to cost. Typically about half the cost of equity, or say mezz, if that's your other option for funding. So it can be a really nice portion of the equity, really by providing, again, this kind of low cost, additional loan, as a part of the capital stack. Conversely, if you're working with a debt fund at a higher cost, what we can do is actually decrease their leverage and just change out dollar for dollar, what they would be loaning to you. Same thing at about a half the cost or so. That really decreases your, weighted average cost of capital. In either scenario, what we're really doing, Bo, is funding capital at lower costs that boost returns. That's really what we're able to do through this vehicle. And one of the advantages PACE Equity brings is that there's lots of compliance and structuring and integration into the capital stack. Do I have to change my design? How do I get my senior lender comfortable with this? Does it work with historic tax credits? We are experts at this. We really pioneered using this PACE tool in a capital stack in ground up construction, in redevelopments, with TIFs and very complex stacks all around the country. So we will work to give our clients we call it a fast track process. It's an all-in soup to nuts approach so that you've got the surety of what the capital looks like from a cost perspective and a sizing perspective upfront.
Very good. So in the capital stack, you have your senior debt, and then you have 10 to 20%, depending on different caveats. So what was happening before, PACE was kind of mainstream, or it's starting to become mainstream now. Everybody's starting to talk about PACE. The sponsors or developers would go and they'd raise equity, or they would get some pref equity from some kind of institutional fund, which the cost of capital is a lot higher, and they would dilute their returns essentially. So from a financial standpoint, PACE in the capital stack is going to increase returns for the sponsorship team. And so that's why so many developers, not only from a financial standpoint, but also from, a social impact, right? They're creating a product or a building that's not only more valuable, but it's more energy efficient and less carbon output, all the good stuff that goes along with building sustainable. So there's like multi-pronged benefits. A lot of the developers out there are always thinking, well, what's in it as far as leverage and that thing, obviously. But so there's many benefits, and that's why this business really started about 10 years ago, right, Ethan? And now over the last 2 or 3 years, it's really just kind of just booming. Right. And last year there was probably like a little bit over $1 billion in CPACE funding. Where do you expect that to go in the next 5 or 10 years?
Well, and Bo, you're exactly right, is that we're seeing tremendous growth on a year-to-year basis for a couple of reasons. One, as you said, really hit it on the head, just becoming more mainstream. People are more aware that, we're out here as a solution and an alternative for them, and they're willing to explore different options, as the pressure on returns and loan to cost and cost of capital has really been, magnified, in kind of our current COVID times. So just general awareness and transactions, helps, that growth. We're also seeing new markets come online. One thing I mentioned earlier is that, so in order to do one of these projects, first there has to be state-enabled legislation. That sets up, what's eligible for funding, what the requirements are, how it works in that specific state. So that's a long process. So, if I started, a new state today, it may take 2, 3, 4, 5 years before I could actually start closing transactions in that specific state. There's 25 states, give or take today, where we can go close and fund a deal, but we've got some major markets, coming online and have come online in the past couple of years as well. So that's really just contributing to, that growth that you mentioned. Another thing that we're seeing a lot of too here at PACE Equity is what we call retroactive refinancing. In about a dozen or so states, if you've recently completed a building, major renovation, even say a PIP or something like that, we can actually pay for improvements that have been previously completed. We call that retroactive financing. So what we're seeing is that, we get a lot of, developers coming to us. I just completed this work. I've got cost overruns. I have, liquidity needs to make sure I, get to the other side of COVID. And we can provide capital in that scenario as well. That's driving a lot of growth also.
And not to mention, we have a couple case studies, right, where because of the costs of timber and lumber going up, that
Exactly.
mid-construction, some developers are reaching out and some sponsors.
Exactly.
And they're kind of in I don't want to say a bad position, but it's a bad position because their only other options to go and raise more equity, right? And so
exactly.
So we've done several, I'm going to call them kind of mid-construction type or construction completion, and that's before the certificate of occupancy. So you have the retroactive, which is after COE or certificate of occupancy, and then there's also the capabilities of coming in mid-construction. Can you talk about a recent mid-construction deal where you guys stepped in and kind of saved the day?
Yeah, absolutely. Well, one that comes to mind is it was a hotel that was under construction, and the flag actually changed their brand standards midway through construction. So the developers faced, a difficult choice. Do we raise more equity or go back to our, pockets and investors to do this work now, or do we simply finish the project, but then, come 24 months after completion, we're going to have to, do a renovation. It's going to cost us more money if we do it later. So we were able to come in and provide the funding for that exactly during mid-construction. Another project we were working on, as they were doing their foundation work, found that they had a lot more needs, on that side than they'd anticipated. It was about a $2 million, increase in their budget. So same thing, they hadn't even gone vertical yet, and we were able to come in and provide the financing for that rather than going back into their own pockets, save their powder for, another, new construction or development project. And that's another scenario we see too a lot, is that this additional funding, you kind of hit the nail on the head earlier. Each of these projects is unique. What value, what role are we playing in them? And there's, 5 different ones that come to mind. One that we're also seeing a lot of is these developers who, would really like to keep the equity, say 100% internal, or between, maybe 2 or 3 people. And we can really help them do that. That way they keep control, upside, and we're a very quiet, partner in a sense. So we're not participating in, the equity returns. We're just, getting our annual payment, and really that's it.
Let's talk about the sizing process, which is
Right.
PACE Equity has it streamlined. So when a sponsor comes directly to PACE Equity, typically you can do a really quick sizing off of construction budget, a pro forma, really a sponsor's resume, right? And you can really in a day's time turn around a indicative term sheet and do a sizing.
Absolutely.
Can you kind of talk about the underwriting or the sizing process, how you underwrite, the 5 pillars, and kind of go into that for the viewers here?
Absolutely. And by the way, Bo, this is like one of the biggest things at PACE Equity that, we take very seriously. We have 100% track record of what we size and engage with our clients to closing. And that's important because, if you think about this tool, as I mentioned, part of it is capital, right? What's the interest rate, right? How much, am I getting through the structure? But the other half, and the much harder half, frankly, is complying with all these vastly different state structuring requirements. So you could have the best term sheet in the world, but if you can't figure out or can't meet those requirements, it really doesn't matter. That's why we have this internal process for the engineering study, for complying with those state criteria, for going through the whole process to get all the approvals that are required from many different parties. So it's always good to understand that that's going to be a major factor as to, how you're closing and achieving that capital is meeting those requirements. So going back to the 5 pillars, as you mentioned, we look at 5 different things in order to size our projects. And some of them are financial. So for example, we're looking for, underwriting requirements that we have through our direct fund of, combined debt service coverage ratio. From an LTV, we like to be less than, say, 25% of the property value. We're looking for, some skin in the game, just like any lender would, of typically, 15%, thereabouts in our projects. So some of those are more, financial. So making sure they meet those requirements. But then we have things like eligible spend. That was a very specific term you yourself used, whereby we have to fund specific items in the budget that meet those state law criterias: HVAC, lighting, windows, roof and envelope, solar, geothermal, sometimes, seismic improvements. So if we're looking to fund, say, $2 million, there has to be $2 million of those specific schedule of value trades in order to achieve that. The 5th pillar then is what those state criteria say. In Wisconsin, which is where we're based, we have an energy savings requirement to comply with. So we have to make sure that there's going to be enough energy savings off your current design. That's an important thing I want to come back to, in order to meet those criteria. Some states have those, some states don't. Some states have a percentage of cost and kind of a complex formula to get there. So we look at all those things, very individually and specifically, trying to find kind of the lowest common denominator. What is going to pull your project down? That's what we really focus on to make sure that we're sizing appropriately. Now, if I can talk about, your project design as well. So a lot of our clients that we're speaking with who haven't worked with us in the past ask us, this is great, but I don't know that I'm building a really efficient, really sustainable building. And, in a sense, I'd like to, or some would like to, not everyone does, and that's okay, of course. But I really want to build my building the way I'd like to build it. So I don't want to have to go LEED or something like that. That's the magic of PACE Equity, Bo, is that we enable our clients to build the buildings they want to build without any design changes. And we'll size up our funding to achieve that. So sometimes what that means is that we may fund a little bit less in some states that have these stricter requirements than maybe the sponsor would like, but they're maintaining their design. We can help in order to work through the design process, if someone's interested in that, to get to a higher funding or a higher efficient building without, say, driving up costs materially. That's another part of our engineering process that we can do. We can identify little changes that drive major efficiency, but not major cost.
And typically there are some competitors out there, but PACE Equity's advantage in the marketplace is that you're a true turnkey provider, meaning everything is done in-house. With other providers, you have to go outsource engineers. You have to, jump through these 80 steps to get to the finish line, where PACE Equity has streamlined the process. And it's kind of the pioneer, right? We've done the first ground up construction project. Kind of talk about some of the kind of paving that PACE Equity has done in the marketplace a little bit here.
Sure. So we are, and you're absolutely right. There's a couple of firms out there that do the funding portion of PACE. And by the way, they're great people. It's just a different approach that they're taking than we've taken. From our chair, the hard part about PACE is that work, that structuring, engineering, qualifying work. There's 100 steps to do in order to really get serious about funding a project. And until those are done, you can't really firm up what the funding is unless you're working with someone who basically has this 100% track record of saying, here's what we can do, and then actually achieving that through our turnkey process. And what that means, though, we are the largest and most experienced CPACE lender and project developer when it comes to construction, ground up construction and development projects, historic tax credits, redevelopment projects. We've done the most. And as you said, we really paved the way. We funded the first new construction, which was a ground up hotel here in Milwaukee. The first redevelopment to use historic tax credits, new markets, opportunity zones. That's really where our bailiwick is. And look, we'd love to do any kind of project, where it makes sense. If it's just adding solar to a building, we love those projects too. But where I'd say we can add the most value to our clients is in those complex, from a financing standpoint, complex from a construction standpoint, development projects.
Excellent. And so on retrofit deals, can you give an example of a recent retrofit deal where a building owner wanted to do some updates and renovations to increase efficiencies, increase value of the property? Can you just talk about a recent project, like the capabilities? It's not just for ground up construction and development.
Absolutely.
And then can you also dive into talking about what property types work for PACE?
Yeah, absolutely. We funded an office renovation project here in Milwaukee last year, whereby the owner was buying it from a long-time, ownership group. And what was interesting about this, it was an office building, and it was 100% gross leases. So the owner, in that case, they're paying all the utility bills, all the expenses for that building. And what's interesting about this scenario is that even with all that incentive, they were still using, non-LED lighting, like a 50-year-old chiller system, and really old elevators. So this owner said, you know what, I will pocket this. And this is not, really invasive or really high cost work. This was, maybe less than $500,000 of work. But doing that enabled them to capture all of that increased efficiency, and actually net of our payment, they are cash flow positive day one, year one, right out the gate by doing that. So there's a lot of different types of properties where we see those retrofit renovation projects, whether it's to simply increase cash flow, whether it's right now to add to your tenant's comfort. If you're funding an HVAC project, we could also incorporate indoor air quality, have people come back to the office or to the distribution center or your retail, strip center, with increased, comfort from that perspective. Maybe it's just to, do a little TLC. It's a competitive leasing market. You need to do some refreshing. A lot of that is going to fall into these categories that we can fund. And just like in this project, adds a lot of value to the building. And you had asked what kind of projects we fund. So really any kind of commercial project, including multifamily of 5 units or greater. So multifamily, office, hospitality, industrial, retail, senior. We're seeing a lot of senior living projects that we're funding as well. A lot of what we fund today is hospitality, multifamily, and senior, with a smattering of office, industrial, retail, thereabouts thereafter.
And we're seeing a lot more of like adaptive reuse projects too. And I would assume that that's going to continue as kind of, the use of the building is kind of obsolete now. Is that kind of, do you think that's going to be the emerging trend to come out in the next couple of years?
I do. I think you're going to see a lot of these, older type of buildings that were struggling pre-COVID aren't going to, haven't made it or aren't making it, unfortunately, through COVID. And so they need to change use, and we're seeing a lot of older hotels and older office buildings that, in a sense, it's what from a positive standpoint, that are getting heavy investment and being brought back to life as alternative uses. We are just working on closing an adaptive reuse of a former, hotel into senior assisted living in suburban Detroit. And again, these are great stories to tell where you can take, a closed, shuttered asset, not doing a lot, for the city and for the tax base. And, in this case, it's a 20-something million dollar project that we're supporting with about $3.5 million of funding to see it, transform and really bring back, that part of that block and community.
So I met with a developer yesterday, and he says, after I gave him the high level overview of the benefits, he says, what are the cons? What are the downsides of PACE equity? And I said, well, really, there aren't many, because higher leverage, pretty inexpensive cost of capital, long-term non-recourse debt. And if it's a construction project, right, the first 2 years are capitalized, which is like kind of having an interest reserve for people that don't know what capitalized is. And so I would say, what are the downsides that you do see is, one, maybe the city or county or townships not opted in, and it might be a little bit of a lengthy process to get, if it's enabled in the state, but maybe not in the city or county, and you would have to get on the ballot to get approved, right? So that could be a little bit of a time consuming. But if it's an opted in city, we're closing transactions in 60 days. So it's not a long drawn out process like doing a HUD construction loan. You can move quickly. So really, what would be kind of a con of why wouldn't be a good fit? I mean, most of the time it seems like it's ideal fit, I guess, if the developer or sponsor has really cheap cost of equity. I mean, maybe if they're an institutional level, but not many people have that. Mm-hmm.
Yeah, I think, I think, if you have, to your exact point, if you have less expensive cost of capital, I'd be the first one to say, good for you. You should be using it. Why are we talking? Now there may be some reasons why, maybe there's a recourse concern, right? Maybe there's, dilution of your own, equity, but chances are, as we see it, if you've got access to that, that's going to be, your first choice. I think the con or the catch, and again, to your point, it's not necessarily a con. There are a lot of moving pieces, and sometimes it does take a while to put the pieces together if the city is not part of a special improvement district, if you're very imminently closing and it's hard to interrupt that process. I think what people often get hung up on is that we have to have the construction lender, the mortgage lender, comfortable with our participation. And people see that as potentially sometimes very challenging. And that's, and I'll say that's a lot of perception. And one of the things we do is work with lenders every day to get them comfortable. Just yesterday, we got a yes from a new lender. Most of the lenders we interact with have never done a PACE deal or don't really understand what PACE is. So a lot of what we do is education. How does it work? How do lenders get comfortable with it? And if we can have a conversation with your lender and we can, work them together, chances are that we can get them comfortable if we have that opportunity. But some lenders will have a knee-jerk reaction or, well, I've looked at this, I don't like the structure, but this is really a solution where the devil's in the details. If we haven't talked to your lender, I would just say, give us that opportunity, because when they hear the details, then there's many things that they like to hear and don't necessarily know just by hearing, property tax assessments for energy improvements.
And I think it's important for people that are watching that there is probably a better way to do this dance, and that's to directly reach out to PACE Equity, because if they get engaged first, they not only have experience with 200 plus lenders that they've worked with, but they can make the introductions, which a big piece of this that I see that goes wrong is that they go out and get senior debt and then they look for PACE, right? And that's not the way to do these deals. You have to get the PACE equity piece first and then do the dance. And you'll have a much better approval rate, because what I've heard from bankers. Well, first of all, a lot of bankers don't know what PACE is. They never heard of it. And now I would say about 40 or 50% of the bankers now understand what PACE is. Now it's starting to, but there's still that big 50% of bankers that have no idea. And if they do know, they have misconceptions about it. Right. And I've never heard anybody explain the way PACE works, because a lot of lenders are worried that, oh, well, this is going to be an assessment through my property taxes. It's going to be senior.
It's going to prime me. Yeah. Right.
And so they don't really understand that if they really heard it from, I actually always say, Ethan has the best way of explaining it. And if you understand how it really works, there's really pretty much no risk for a senior lender.
That's right.
And actually, it's probably a safer investment for them because their loan to cost is substantially less than if they were lending a higher loan to cost. So really, there's many benefits, and right. I think pretty much every lender you talk to, at least 8, 9 out of that 10 are fine with it after they hear actually how it works. And that brings me up to this topic. Can you talk about that it's not a lien like a mortgage lien, how the assessment works, and how do they pay this assessment essentially?
Sure. So and that this is one of the topics that really helps mortgage lenders get comfortable with PACE financing. So when we close and fund, we provide our clients a fixed interest rate and amortization for the entire term, and the term and the AM are matched. So say that's a 25, 30 year term and amortization at a fixed interest rate. It can never balloon, reset, reamortize, whatever the case may be. So it's a fixed payment every year for that whole period. Let's say, just to make up some numbers, that it's $1 million of financing, and maybe the annual payment is $75,000, just to, again, kind of make up some round numbers. So that $75,000 would be paid sometimes annually, sometimes semi-annually, with your real estate taxes or through a special servicer kind of at the same time you pay your taxes. And that's it. That's our only payment is on that annual or semi-annual basis. The really great thing, Bo, is that in no scenario can we accelerate payments, principal, put a lien on the building for that $1 million, say, principal balance. All that has to be done is just pay the annual or semi-annual assessment. It can be paid in arrears, and typically what sometimes happens if you're late on your taxes, that payment just waits, and then it can be caught up by you or the mortgage lender or whomever. But in no default scenario can we, unlike a mortgage, could we say, your $1 million of financing is now due, and there's a lien on the building, and we're calling recourse and all that. It's just that $75,000 payment for 25 years. And one other nice feature is that we can be prepaid at any time. So it gives flexibility to say, I had, this project for 5 years. I'm going to go sell it and pay off all my financing. But we can also be transferred, no cost, no, penalty, no re-underwrite, along with the land, kind of like an assumable loan, or say like a sewer assessment or something like that. So that whole structure, again, gives a lot of comfort that, okay, I know exactly what my yearly payment is going to be throughout the whole 25-year term. I can underwrite to that. I can predict cash flow because of that. It's a very small portion of value on a yearly basis. So that really helps mortgage lenders to get comfortable that, okay, I'm not, say, ever going to be, there's never going to be $1 million all of a sudden of a surprise tax assessment. It's just this very predictable payment stream.
And I think that's important to note that this PACE equity financing is long-term, non-recourse. So essentially, if the senior debt is a construction to perm, they don't need to refinance upon stabilization. They can keep this long-term if they wanted to. Now, a lot of the developers and sponsors do end up refinancing at stabilization because they, pay back their investors or whatever their structures are. But there's many options to structuring these. Now, what are your capabilities? Let's talk about like capabilities, like typically like a small sized financing deal would be about $700,000-800,000 on the very small side that we're doing, versus on the large scale, we have the capabilities of doing a $200 million project. So essentially $40-50 million in PACE financing.
Yeah, I think everyone asks, what's the minimum size? And we can actually go as low as $100,000, project. The challenge, Bo, is that, there's always going to be, legal costs. And, as we all know about lawyers, the legal bill and the size of the project are not always, commiserate. So what we've seen is that it is somewhat in the eye of the beholder. We can do $100,000, $250,000 projects, $500,000 projects. So if you ask 3 people, some would say, I really need this, $200,000 to renovate my building. It's okay that the transaction costs are a little bit higher than they would be if it was $1 million, even though dollar for dollar, it's the same, but just from a percentage basis. So really you could just say it's $100,000 and up. Some clients would say, for the costs, and kind of, even though PACE Equity is handling the hoops, I'm still involved. There's another party to my, financing. So $1 million is a better fit. Generally speaking, our transactions are in a band of, 1 to, $30 million with some large projects kind of outlaying that, pushing that, range up. But really, I think the $500,000 million and up, generally speaking, that's where most people, tend to be interested. And there's no real upper limit. We can do, very large projects. We can do a portion, of a large project. Some projects we do large percentages of, 20, 30% of cost. Some projects we do 5 or 10% of cost. We're here as a value add tool. And you're going to have the best view of what that value add is. Is it $5 million on a $50 million project? Is it $5 million on a $20 million project? So wherever we can add value, that's really what we're interested in. We look at ourselves as a partner, with our clients, and we want to support them in ways that they want to be supported.
And kind of to wrap this all up, I mean, when it comes to more complex deals where it's in an opportunity zone, historic tax credits, TIFs, essentially the PACE Equity team has worked with all of that before, and it doesn't scare you off, and the more challenging the better, right, Ethan?
Yeah, the more challenging the better. And we've done projects with ground leases, tax abatements, historic tax credits, multiple lenders, 10, 12 sources of capital. That's great. We love those. And one thing you said earlier that I'll reiterate is that we like to be in these projects, early if we can, and just work alongside for the whole life cycle. If we close a transaction in 60 days, that's fantastic. If we close a transaction in a year, but we were an early part of the stack, we really helped to, put it together, work in fits and starts, that's great too. So it's never too early to be working with us, and we can add so much value throughout all parts of the project and transaction if we're getting involved early as well.
Well, thank you so much, Ethan. This was really good. I hope everybody got a really good overview. You've heard me talk about PACE Equity before, and now you heard from the legend himself, Ethan, about the advantages of PACE Equity. So thank you so much, Ethan. Appreciate you joining us.
Thank you very much. Really great to be here.
Thanks for listening to the Investor Financing Podcast. For show notes and useful resources, please visit investorfinancingpodcast.com. For questions or comments, email info@investorfinancingpodcast.com. If you enjoy our show, please share it with your network. Until next time.